Welcome to the Opening Bell Report.
Today's mission is focused on a question that has been echoing across trading floors, and it's about whether this is the ultimate comeback. Why Sweetgreen stocks surged today.
It's quite a story.
Right. We are looking at a massive glaring contradiction in the stock market, and I want you to just imagine this scenario for a second.
Okay.
A widely known company reports their end-of-year financials. The numbers are absolutely brutal. We are talking about plummeting sales, widening financial losses, and a bleak picture across the board.
The kind of report that makes investors panic.
Exactly. Naturally, you would expect the stock to absolutely tank. But instead, the stock price surges. It jumps up. How does that actually happen?
It is one of the most counterintuitive dynamics in the financial markets. It completely defies everyday logic.
It really does.
Because when you see bad news in the real world, you expect a bad outcome. But the equity market is a different beast entirely. It doesn't always operate on rearview mirror logic.
Right.
It operates on future probabilities. And that disconnect between past performance and future expectation is exactly what we are going to unravel for you today.
Exactly. And to figure this out, our insights today are drawn exclusively from a very detailed analysis report on Sweetgreen Incorporated. They trade on the New York Stock Exchange under the ticker SG.
A very familiar name for a lot of people.
Oh, absolutely. Okay, let's unpack this. Sweetgreen stock closed at $6 flat. That is up 6.76%, which is an increase of 38 cents on the day.
A solid day.
And it managed this impressive rally despite the data showing that their Q4 same-store sales plummeted by a staggering 11.5%.
Just a massive drop.
Not only that, but their broader financial losses actively widened. It is a true head-scratcher. Before we get into the mechanics of the surge, can you set the stage for us? What exactly is the current state of this company?
Well, to understand the market's reaction, you have to understand the identity crisis the company's been going through.
Identity crisis.
Yeah, because Sweetgreen isn't just any restaurant. It is a high-end, fast casual salad chain. For a long time, leading up to and immediately following their IPO, their entire identity in the market was built around this high-growth, tech-first narrative.
Right.
They positioned themselves as a technology platform that just happened to sell salads. And that narrative commanded a massive premium valuation.
People are buying into the tech hype.
Exactly. But recently, reality caught up with them. They have had to completely abandon that flashy narrative. Right now, they are in the middle of a very gritty, painful restructuring process.
So the focus shifted.
Entirely. The focus is no longer on endless, unconstrained growth. It is purely on survival, cost-cutting, and carving out a realistic path to actual profitability.
So we know the narrative shifted, and we know the headline numbers were bad, but just how bleak was this baseline they were starting from? Walk us through the financial reality of their fiscal year 2025.
It was rough.
Because looking at the analysis report, it seems like a perfect storm of bad metrics.
It was incredibly grim. Let's start with the top line. Revenue for FY 2025 was basically stagnant at $679.5 million.
Stagnant.
Yeah, that represents a year-over-year increase of a mere 0.4%.
0.4, that's nothing.
Right. Now, for a mature utility company, 0.4% might be acceptable. But for a company that went public, pitching itself as a hyper-growth machine,
It's basically a failure.
0.4% is essentially standing still. You are actually losing ground when you factor in inflation. And as you move down the income statement, the bleeding becomes much more obvious. Gross profit dropped 22.1% year over year,
Wow.
landing at $103.5 million.
And a drop in gross profit usually implies that either the cost of the ingredients went up significantly or they're having to discount their product to get people in the door, right?
Exactly. The core unit economics were deteriorating. But that gross profit number is just the tip of the iceberg when you look at the heavy operational costs required to run their corporate structure.
It gets worse.
Oh, yeah. Operating income hit a deeply painful negative $139.3 million.
Negative 139.
And net income available to common shareholders came in at negative $134.1 million.
That is wild.
Furthermore, their diluted earnings per share missed Wall Street forecasts entirely, coming in at negative $1.14. Free cash flow was negative $80.2 million.
Ouch.
And adjusted EBITDA, which is a crucial proxy for core operational cash flow, sat at negative $11 million.
I am looking at these numbers and I just have to ask, how does a company lose roughly $134 million in a single year just selling salads? That is a staggering amount of capital to burn through.
Synthesizing these metrics paints a very clear picture of a severe cash burn rate. The company was essentially a furnace for capital.
A furnace. I like that analogy.
And for you, as an investor tracking a company burning cash like that, the immediate concern is dilution risk. They ended the year with 118.3 million shares outstanding.
Okay.
When a company is operating with an $80 million negative free cash flow deficit, the market assumes they will eventually run out of money.
Because they have to pay the rent somehow.
Exactly. To keep the lights on, management is typically forced to issue new shares to raise capital. This waters down the equity. Your slice of the pie gets smaller just to keep the bakery open.
That makes the 11.5% drop in same-store sales in Q4 look even more terrifying. We all know that top-line revenue only grew by 0.4% because they opened a few new locations.
Right, new locations mask the underlying decay.
But same-store sales is the true pulse of a retail brand. A near 12% drop means their core, loyal customers are actively walking away.
It is the most damaging metric in a physical retail business because of how operating leverage works. A brick-and-mortar restaurant has incredibly high fixed costs. You sign a 10-year lease for premium urban real estate, you hire a set number of staff, and your utilities run all day.
Those bills are due no matter what.
Those costs do not change regardless of whether 100 people walk through the door or 1,000. When foot traffic declines by 11.5%, you lose the high-margin revenue that sits on top of those fixed costs.
So the profits just vanish.
The fixed expenses remain rigidly high while the revenue to cover them shrinks rapidly. That accelerates that cash burn we just talked about.
Okay, so that establishes the baseline. The core business is bleeding, foot traffic is vanishing, and they are burning cash. This brings us right back to our core mystery.
The stock jump.
Yes. If the situation was this dire, why did the stock close at $6, jumping nearly 7%? It clearly wasn't just random market volatility.
Not at all.
The data shows this surge was driven by massive liquidity entering the picture and some serious insider confidence.
You have to remember that the market is a forward-looking discounting mechanism. It doesn't care about the terrible year you just suffered through if it suddenly believes you have a viable, funded plan to survive the next 2 years.
Survival is key.
The market was pricing Sweetgreen for imminent bankruptcy. But then, a massive catalyst hit the tape. A $100 million safety net.
Wait, hold on. If they were burning cash like a furnace, as you said, how did they suddenly pull a $100 million safety net out of thin air? Did they take on massive high-interest debt?
No. And that is what makes this so pivotal. They sold an asset.
Ah.
According to the analysis report, Sweetgreen divested its robotics unit, a division called Spice. They sold it to a food tech company named Wonder.
Wonder, okay.
By offloading this division, Sweetgreen pocketed a cool $100 million in pure cash.
That's a lot of cash to just drop onto the balance sheet.
Now let's look at what that does to their situation. They ended 2025 with about $89 million in cash. Following the finalization of the Spice sale in Q1 of 2026, their cash reserves are immediately boosted to roughly $189 million.
Huge difference.
What's fascinating here is that this specific cash infusion effectively removes any bankruptcy risk for the entirety of 2026.
That completely flips the script. The existential threat, the fear of the stock going to absolute zero is suddenly taken off the table.
It fundamentally changes the investment thesis. It transitions the stock from a distressed, high-risk distress play into a funded turnaround story.
Funded being the operative word.
Management now has a very comfortable 2-year runway to actually fix the underlying traffic and margin issues. And they can do it without the looming threat of insolvency or the need for a highly dilutive capital raise.
Which protects the current shareholders.
Institutional investors saw that $100 million hit the balance sheet and breathed a collective sigh of relief, which initiated the buying pressure.
It buys them time. And in a turnaround scenario, time is the most valuable asset. But there was a second distinct bottoming signal that really caught my eye in the report.
Insider buying.
Yes. Co-founder Nicholas Jamet recently increased his personal stake in the company by a massive 24%.
That is a huge statement.
He was buying shares on the open market at an average price of $5.71. Now, we both know insider buying is generally a bullish signal, but what makes a 24% stake increase at that specific price so significant for this company right now?
It comes down to informational advantage and timing. As a co-founder and a top executive, Jamet is looking at the internal, daily foot traffic data. He sees the real-time cash flow metrics and the early results of their cost-cutting measures.
He sees the data before we do.
He knows exactly how the business is performing today, not just last quarter. Making an open market purchase that large, increasing your holdings by nearly a quarter, tells Wall Street that the internal bleeding has stopped. He is putting his own wealth on the line to signal that he believes the stock has hit its absolute floor.
So when retail and institutional investors see the architect of the brand aggressively buying the dip, they interpret it as the ultimate vote of confidence.
Exactly.
It tells the market that the current valuation is a severe mispricing. But confidence and cash only get you so far if the core business model is still fundamentally broken.
True.
And speaking of where the business is heading, the analysis report details a major strategic shift that is honestly mind-blowing. Here's where it gets really interesting. Sweetgreen has an aggressive new strategy for 2026, and they are calling it the Infinite Kitchen.
The Infinite Kitchen. It certainly sounds ambitious.
It really does.
But it represents a very real, very calculated operational pivot away from the traditional restaurant model.
The core of the strategy is that Sweetgreen plans to roll out 15 new automated make-line units throughout 2026.
Robots making salads.
We are talking about essentially automating the physical assembly of the food. Imagine walking into a location, and instead of a line of 4 or 5 employees manually scooping ingredients, tossing the greens, and packaging the bowl, you have a mechanized system doing the heavy lifting with precision.
It's like a factory line.
But how does mechanizing the salad line actually change the underlying unit economics of the business?
It attacks the single largest controllable expense in the food service industry: labor.
Labor is always the biggest cost.
The restaurant industry is notorious for razor-thin margins, largely because human labor is incredibly expensive, inconsistent, and prone to high turnover. If Sweetgreen successfully hits this automation goal and deploys these 15 units effectively, the data projects that their labor costs at those specific locations could drop by 30%.
30%.
30%.
In a business model where a 2% improvement in labor efficiency is celebrated, a 30% reduction is completely transformative.
It changes the entire math and profitability for a single location.
But does that actually fix the underlying issue they've had with their identity? You mentioned earlier they tried to be a tech company.
It actually forces them to live up to it. For years, as we discussed, Sweetgreen talked about being a tech company while operating exactly like a traditional labor-intensive restaurant.
Right. An app doesn't make you a tech company.
This Infinite Kitchen rollout shifts the company from just utilizing an app for ordering to actually deploying hard technology to aggressively slash overhead.
It's physical tech.
If they can execute this rollout without degrading the food quality, it fundamentally alters their cost structure. A restaurant with 30% lower labor costs requires significantly less foot traffic to break even, and that justifies a massive valuation rebound in the eyes of the market.
That makes the $100 million runway from the spice sale incredibly important. They now have the actual capital required to build out these infinite kitchens, fund the capex, and prove to the market that the concept works at scale.
They finally have the war chest to do it.
But let's talk about that potential valuation rebound, because the report breaks down the valuation gap between Sweetgreen and its direct competitors, and it perfectly illustrates why investors rushed in today.
The peer comparison is where you really see the magnitude of the opportunity that value investors are betting on.
Let me break down the price-to-sales ratio, or PS, because the disparity is shocking. Sweetgreen is currently sitting at a historic low of 0.9 times sales.
0.9.
To put that in perspective for you, for every single dollar Sweetgreen generates in revenue, the market is currently only willing to pay 90 cents for the stock.
It's practically a distressed asset.
Historically, during their high growth days, they traded at 4 times sales. So they have fallen from a massive premium to trading at a discount to their own revenue.
If we connect this to the bigger picture, you have to look at how the market is treating the rest of the fast casual sector. The analysis report compares Sweetgreen directly to CAVA and Chipotle.
2 heavyweights.
Right now, CAVA is trading at a price-to-sales ratio of 5.1 times. That means investors are willing to pay over $5 for every single dollar of CAVA sales.
Wow.
Chipotle trades at 3.6 times. Sweetgreen is stuck down at 0.9 times.
That is a massive gap.
The broader market is currently pricing Sweetgreen like a failing legacy retail chain, completely divorcing it from the growth multiples enjoyed by its peers.
They're basically in the bargain bin. But the difference in free cash flow really highlights why the market lost confidence in them in the first place.
Exactly.
The data shows Sweetgreen's cash flow as a percentage of sales is currently a negative 11.8%. Contrast that with Chipotle, which is sitting at a highly profitable positive 18%.
Game day.
That right there is the fundamental reason for the valuation gap. One company is printing money from its operations. The other is losing nearly 12 cents on every dollar it brings in.
But that stark contrast is exactly the catalyst for this stock surge. Value investors look at that massive gap and see an asymmetric opportunity.
How so?
If Sweetgreen can close that gap even marginally, if they can just stop the bleeding, the stock has immense room to run upward just to reach a normal industry valuation. And there's a very specific data point in the company's 2026 guidance that gave investors the permission to start buying.
Right, the 2026 silver lining. This is the ultimate reason why the analyst median price target is currently sitting at $8.55.
Which is a big jump.
Keep in mind, The stock closed today at $6, so a target of $8.55 implies a massive 42% upside from here. The reason for this bullish outlook is that for the first time in the company's entire history, management's 2026 outlook expects a positive adjusted EBITDA.
Positive, finally.
They are forecasting it to land somewhere between $1 million and $6 million.
Now, on the surface, that might sound like an incredibly tiny profit margin.
Yeah.
Earning $1 million to $6 million on roughly $680 million in revenue is essentially a rounding error.
Right. It's tiny.
But psychologically, for institutional capital, crossing the threshold from negative cash flow to positive EBITDA is a monumental milestone.
It's the proof of concept.
It proves that the core business model can actually sustain itself without external funding. Investors concluded that the absolute worst-case scenario of bankruptcy was already fully priced into that $6 stock. The market had already punished them maximally for the 11.5% drop in foot traffic.
So because the expectations were dragged down so incredibly low, any operational win becomes explosive. Hitting a positive EBITDA, or successfully launching the Infinite Kitchen, acts as a massive catalyst because the stock is priced for failure.
Exactly.
When you are priced for bankruptcy, merely surviving is a massive victory.
Thriving, even a little bit, is a home run. It is a classic shift from evaluating a company on pure revenue growth to evaluating them on their turnaround efficiency.
So what does this all mean? If we step back and look at the entirety of the situation, the key takeaway for you is this. In the stock market, a distressed turnaround story can be incredibly powerful.
Very powerful.
A narrative driven by brutal, necessary cost-cutting, aggressive automation, and a sudden, massive cash infusion can often be a much stronger catalyst for a stock surge than pure top-line revenue growth.
People love a comeback.
Investors love a comeback, especially when the downside risk has been essentially removed by putting $100 million in the bank, and the insiders who know the company best are aggressively buying up shares. It completely flips the investment thesis from how fast can they expand to how efficiently can they optimize and survive.
It demonstrates that the market rewards discipline just as much as it rewards growth, provided the timing is right. But analyzing all this, especially the transition toward automated make lines just to save the profit margins, brings up a broader philosophical dilemma for this entire sector.
I can see where this is going.
This raises an important question. If high-end, fast casual dining now relies on 30% labor cuts through robotic infinite kitchens just to survive and appease Wall Street, what happens to the human premium feel of these brands?
Oh, that is a fascinating point. The aesthetic was the whole selling point.
Think about the origins of the fast casual boom. Sweetgreen built its brand equity on the aesthetic of fresh ingredients being handled by real people right in front of you.
Tossing the salad right there.
It felt artisanal, customized, and distinctly human. Will you, the consumer, still be willing to pay a premium high-end price for a salad that was assembled entirely by a machine?
Probably not.
Or will this desperate, margin-driven push for automation ultimately strip away the very luxury, human-centric aesthetic that made brands like Sweetgreen popular in the first place? It is a very fine line between optimizing your cost structure for the stock market and alienating the customer who actually buys the product.
That is such a great thought to leave you with. Is a robot-made salad still a luxury salad, or is it just high-tech fast food? We will have to wait and see how consumers actually react to these infinite kitchens in 2026. Thank you so much for joining us on this deep dive into the analysis report. We hope this helped decipher the complex mysteries of the market and the realities of the restaurant industry for you today. Keep learning, keep questioning the numbers behind the headlines, and stay curious. See you next time.
Don't forget to like, share, and subscribe for more.